Hey everyone, welcome back to Corporate Dakota, the place where we unpack the secrets hiding in plain sight within corporate filings to give you the real story about what is happening behind the scenes. Today we are looking at an 8K filing from Inspire Veterinary Partners, Incorporated, a company that for some reason is facing a bit of a predicament. So in simple terms, an 8K report is like a company's public diary entry it's filed. When a company needs to announce something big, something that could change how investors see the company, its stock, or its future. This filing is all about Inspire Veterinary Partners and a rather unwelcome piece of news they received from the Nasdaq stock exchange. Now, Nasdaq is the big leagues for many companies, a place where they list their shares for public trading. But to stay listed on Nasdaq, companies have to follow certain rules. One of the most basic rules is keeping their stock price above a certain level. Think of it like this: Nasdaq wants to see that investor confidence in the company is strong enough to keep the stock price from falling too low. Inspire Veterinary Partners received a notice letter saying they are not in compliance with this minimum bid price requirement. Basically, their stock price has been too low for too long, specifically for 30 business days in a row. This is not good for a few reasons. For one, it can make the company look unstable to investors. It can also make it harder for the company to raise new money or attract talent, because people might see it as a struggling business. What makes this situation even more serious is that the notice explains the company is not even eligible for the usual grace periods that other companies might get to fix this problem. This is because they have done a reverse stock split not once, but multiple times over the past 2 years, with a really significant ratio. A reverse stock split might sound complicated, but it's basically when a company decides to reduce the number of its outstanding shares by combining them. So if you had 10 shares before a 1-for-10 reverse split, you would end up with just 1 share. The idea behind this can be to artificially boost the stock price per S-share to meet listing requirements or to make the stock look more appealing. However, doing this multiple times like Inspire Veterinary Partners has suggests they are repeatedly struggling to keep their stock price up naturally. It's like trying to fix a leaky boat by patching holes multiple times instead of finding the main leak, the fundamental issue. The consequence of this non-compliance is stark. Their securities are set to be suspended from trading on the Nasdaq Capital Market, which is part of the Nasdaq exchange. This means their stock will no longer be bought and sold on Nasdaq starting on the 24th of November, and to top it off, a formal document called a Form 25, NZS, will be filed. This document formally removes the company's securities from listing and registration on Nasdaq. Essentially, they are being kicked off the main exchange unless they can do something about it. Now, it's not entirely over for Inspire Veterinary Partners. They have a chance to fight this. The company can request an appeal of this decision to Nasdaq's hearings panel. They have a deadline to do this, which is the 20th of November. If they do request this hearing, it will put a pause on the suspension and delisting process. The hearing will then decide if the company can stay listed. However, and this is important, the filing makes it clear there is no guarantee or assurance that the panel will agree with the company. Even if they get a hearing, there is no promise they will be allowed to stay on Nasdaq. They might have to explain how they plan to fix the underlying issues that led to this situation, and how they will maintain compliance in the future. This is a very precarious position for any public company to be in. The report is signed by Kimball Carr, their president and chief executive officer. This tells us that from the top leadership is aware and is taking responsibility for this filing and the situation it describes. Now let's look at what this means for Inspire Veterinary Partners. The fact that they've had to resort to multiple reverse stock splits points to a persistent issue with their stock performance, likely stemming from underlying business challenges. Investors are clearly not valuing the company's shares at a level that meets Nasdaq's base requirements. This could be due to a variety of factors such as poor financial performance, lack of growth prospects, or market skepticism about their business model. The immediate risk is delisting, which would significantly reduce the liquidity of their stock, making it harder for existing shareholders to sell their shares and much harder for the company to attract new investment. It might push them to a different over-the-counter market, which generally attracts more speculative trading and lower trading volumes. The company's future hinges on convincing the Nasdaq hearings panel that they have a viable plan to turn things around and meet listing standards. Without that assurance, their path forward as a publicly traded entity on a major exchange looks extremely challenging. This filing is a clear warning sign that Inspire Veterinary Partners is facing significant headwinds. Their ability to overcome this delisting threat will depend heavily on their strategic decisions and their capacity to demonstrate tangible improvements to their business and financial health. It's a critical moment, and their next steps will be closely watched by investors and the market. Alright, that is our breakdown of Inspire Veterinary Partners' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.